Okay, so let's discuss chapter 12, estimating the cost of capital. There are about 57 slides, and we have about 40 minutes to discuss this chapter. And cost of capital concept is really, just in one equation you can illustrate the cost of capital. So essentially, we call it weighted average cost of capital. This big equation. So what are the capital components? It could be debt. So let's say debt. Could be stocks or equity. Equity, you could have a preferred stock. Preferred and common stock. So let's just stay out with the preferred. Let's just call this equity, okay? So you have debt and equity. Okay. So in this case, would be WD, RD, 1 minus T, any tax benefit, plus WE, equity, RE. So this is really just cost of capital equation, the big equation. So what we need to know is to know the capital structure. The first thing is capital structure. The structure means the percentage used. How much debt do you use? What percentage of debt you use in your business? So that's what we call the capital structure, how you finance the company or the product by the combination, the mixture of debt and equity. Once we have the capital structure part, then if we have the cost of each component, the cost of debt, cost of equity, then combined with the tax rate, then we can calculate or estimate the cost of capital. And in this chapter, we first look at the equity cost of capital. And then we look at the debt cost of capital. Okay, so this is RE, and this is RD, and here we have the WACC. So that's in a nutshell for this chapter. And next, let's look at the details. So the equity cost of capital is a CAPM equation, capital asset pricing model. So it's the risk-free rate plus a risk premium. So this is a risk premium. Okay. So it should be this entire thing. It's a risk premium for security I. So the bracket should stop all the way here. Okay. So in this sense, we know this. We use a T-bill or T-bond as a proxy. And here we use SP500, so we know these numbers, and then we can calculate estimate the beta for the equity for the stock. Then we can calculate the equity cost of capital. So here we have a standard deviation or the volatility. We have beta. Which stock carries more total risk? So the higher volatility, the higher total risk. So this table A. Which has more market risk? Higher beta has higher market risk. So this has higher beta. So Disney. If risk-free rate is 3%, market return is 8%, what's the equity cost of Disney? R Disney is equal to RF. 3% plus beta times a market risk premium, which is 8% minus 3%, because the excess market return relative to the risk-free rate. So 8 minus 3. So that's how we calculate the cost of equity for Disney. And similarly, you can calculate the cost of equity for AAA. So that's the equation here and here. The market portfolio. So how do we construct a market portfolio? It's a weighted average. And in this case, we choose to use a value weighted average. For S&P 500, it's a value weighted. So bigger companies get a higher weight. Whereas Dow Jones is price weighted. So higher priced stock get a higher weight. And Nasdaq, I believe, probably, let's see, I think there's a equal weighted. That means all stocks get equal weights. So there are different weighting schemes. And in this case, we talk about the value weighted. That's weighted by the, so the denominator is the total market value, okay? So for passive portfolio, the portfolio is not rebalanced. For active portfolio, if you want to maintain a certain percentage, like always maintain 10% in Amazon, then Amazon price increase, then you have to sell off part. If the price decrease, you have to adjust, accordingly. So that's called an active portfolio. Market indices, there are S&P 500, which is value weighted. Wilshire is value weighted, and Dow Jones is price weighted. And we typically use S&P 500 for the US market as a measure of US market because it has the 500 largest US stocks. And if you don't have much investment experience, I would encourage you to invest in index funds. And try to find the ETFs with lower load. That means lower fees. Okay, lower fees. The market risk premium is the difference between market return and risk-free rate. So that's what we call market risk premium. Okay. And historically, if we look at the market risk premium is between 4% and 8%, right? So that's the excess return relative to the risk-free rate. So what is risk-free rate? Well, it's really, really hard to find a good proxy for it. So somehow you have to match this risk-free rate with your project. Okay. In my, in a lot of calculations we have done, for academics, it's using the 1-year Treasury T-bills. And if it's long-term, like for the company, we could use 10-year Treasury bonds. But as long as you stick with one or the other, it's okay. And because it's just a proxy, you cannot get a perfect proxy. Market risk premium. And we could also use the dividends from S&P 500 and the expected dividend growth rate to calculate or estimate the market risk premium. And NYU's Professor Demodorin, he did a lot of calculations, and on his website you'll find a lot of information about this dividend yield, S&P 500, and etc. And you could also construct this database yourself. Beta. So how do we estimate beta? Beta is the sensitivity of the stock relative to the market. So what is the market? Well, that's controversial, but on Wall Street, it's mainly using S&P 500. Okay, once you determine, okay, we use S&P 500 as a market proxy, then what time period? Because the sensitivity may change over time, so we have to choose a interval. Okay, and typically on Yahoo Finance they use monthly returns, and for last 5 years, for example, and then you do those you construct that the return for a specific stock versus the return for SP 500 monthly over the last 5 years. You build that slope, and that slope is the beta for the stock. So this is what I talked about, this beta. So this is the slope 1.5. So beta is in this case 1.5647. And note in this chart, this is a stock. Vertical is the stock return. Horizontal is the market return. So beta estimation. So I would encourage you to do something like this. Repeat this calculation for Cisco and see if you get similar returns. So repeat this to replicate if you can. Okay, and then you do this calculation for different stocks, etc. When I was a student, I replicated a lot. Okay, so replication is a way to master certain concepts. And we could use a linear regression method to estimate the slope. Okay, this is called the parameters, right? So you run a linear regression, and you can run the regression in Excel as well. And in addition to this, what's estimated by CAPM, we have an extra alpha term. And for hedge funds, they really are aiming for this alpha, positive alpha. That means you generate extra returns not seen by the market, so that you beat the market in the sense. So if alpha is positive, the stock has performed better than predicted by the CAPM. So if you are going to start a hedge fund, you want to have a strategy that you can generate a positive alpha or excess returns, extra returns. Then you'll get more and more followers and investors. You may, not consistently getting positive alphas, but over time or over a combination of portfolios, if you are getting positive alphas, then you are considered really good managers. So that's cost of equity. The next component is cost of debt. Cost of debt, you can use the bond issued by the company and the bond ratings. From Fitch, from SP500, from Standard & Poor's, and other rating agencies. So based on the bond ratings, you can really estimate the cost if the company is going to issue a new bond. And that's what we call a yield to maturity method as well. So it's talking about the probability of default. If you have a probability of default, and if the company indeed is in default, how much money you can recover? If for $100 you can recover 80, then you have the loss rate of 20. You lose $20 there. And the rating agency will estimate this for you, and it depends on this probability. The bond will be rated as AA, triple B, etc. if anything before double B is considered above that it's an investment grade, and below would be junk bonds. Okay, so here, so that's how the rating works. And the rating are related to the default rate. The higher the default rate, the higher the probability of default, means you cannot recover your investment. So as you can see here, it's quite risky, okay? Sometimes we also use debt betas to estimate the debt cost of capital using capital asset pricing model. But this is not common. Okay. And if you want to get more ideas about how to estimate debt betas, you can use chapter 21. And debt beta, usually you start with the asset beta, and then you look at the equity beta. And this asset beta is a combination of debt and equity. So from there, you can get back out the debt beta. These betas tend to be low because they don't really move much with the market. You see, the debt beta is close to 0. So this is a CAPM, right? CAPM. And then for the project cost of capital, if it's all equity, then the cost of capital is just cost of equity. If it's a combination of equity and debt, then it's a weighted average. So if it's a leveraged firm, then it must be a combination of debt and equity. If you use debt, then it's a levered firm. If you have no debt, you don't have leverage. It's all equity. So this is your asset and financed by debt and equity. So this is the capital structure, capital components. And you look at the example, and there are solutions there. If you have questions, just email me and let me know. And if you find any errors or mistakes there, please just use your best judgment. And if you are not sure, just contact me for more information. And project cost of capital here, you can see this is WE, right? So WE is the equity market value over the total value. The total value is nothing but the debt and equity combined, right? And similarly, WD, this is WD, right? And it really should have 1 minus T because there is a tax benefit there. So if there's no 1 minus T here, it's assuming tax rate is 0. Then it's 1 minus 0, it's 1, right? Okay, so weighted average. Cash is considered a negative debt. Cash can lower your debt because you can use cash to pay part of the debt. So the net debt is the difference between debt and cash. Cash include just cash and short-term investments. You see, Microsoft has a market cap of $716 billion, and this much debt, this much cash. So essentially, it has really its cash more than offsets the debt. So it has a negative net debt. And if you look at here, because you have a negative net debt, the unleveraged, with debt, you would lower your beta. But without debt, with negative debt, your beta actually increased from 1.04 to 1.11. So that means Microsoft equity is less risky than the underlying business activities due to its lower its cash holdings. So beta E is less than the beta of the unleveraged company. So if you have cash holdings, so if we are the investors, if the companies have excess cash holdings, that lower our risk. Because if you have a lot of cash holdings, you are not going to go bankruptcy any moment soon, and then the risk is lower. So choose a company with a good balance sheet is one of the keys in successful investment. Industry asset betas. So industry will differ from each other. So we could estimate the industry beta. So we could estimate, combine the estimate of asset betas for multiple firms in the same industry. And if we do that as our benchmark, that reduces our error. So here we have the equity beta, debt rating. We have a combination of companies. This is in the same industry. And we could estimate for dealers. We could do weighted average of the beta. And that because dealers has a lot of debt, 59% of debt, right? 59%, 0.59. So it's overall beta is going to be lower relative to the equity. Because equity, once you have debt, you have a probability of default. So if in default, equity get nothing, equity shareholders, and therefore the risk or the beta is much higher. So for equity betas, for debt beta, asset beta, and then we can do an average for the industry. So you start with equity beta. So that's the starting point, and then find out the leverage. From there, go into the debt beta and calculate the asset beta and do the average for the industry. And the industry asset betas, if you look at here for different industries, which industry is riskiest or which one is safest? The safe ones here you see utilities and gold on this side, lower risk, and higher risk. Why utilities are lower risk? Because they are highly regulated and they pay fixed dividends, and their dividends typically tend to increase over time as well. And here on the other side, you have semiconductors, you have technology, etc. So you have a higher, it's riskier. So you have higher betas. And the project risk, apparently the financing depending on the project risk. And the firm's asset betas reflect the market risk of an average project. If your project is riskier than average, then you need to adjust for that extra risk. so need to be adjusted. However, for a big company, they have a lot of products, and let's consider within the company diversification. You have a high risk, low risk products, and these products do not correlate with each other. Then it's diversified. So 3M is a good example. And the project risk is related to degree of operating leverage. Operating leverage is related to the fixed cost and variable cost. If your fixed cost is higher, then you have a higher operating leverage. Like if we look at Ford versus Microsoft, Ford is going to have a higher operating leverage because they use more fixed assets, whereas technology companies, they have lower fixed assets. Operating leverage and beta, and this example look at how they relate to each other. And if the company uses leverage to finance a product, that means use debt financing. How might the project's cost of capital change? So in a perfect market, if it's a perfect market, then the choice of financing should not influence your cost of capital. However, due to government policies, especially the tax policy, that is favorable because interest expenses are tax deductible, so that you have this tax benefit. So we also call it a tax shield. So interest expense provides the company with a tax shield. And now you finally have this 1 minus t into the equation. My pen is out of power, I guess. So essentially here is a T, tax rate, corporate tax rate. And this equation is talking about WACC, okay, WACC. And here you see this big equation, WE, WD, RERD, and without tax. And this is a with tax, okay, with tax. So tax, you see with tax, this gets lowered, okay, it's lowered. Why? Because of the tax benefit of debt. Final thoughts on the CAPM. And there are a lot of assumptions. And in real life, we deviate from these assumptions. For example, perfect competition. It's not perfect competition. Trading cost, as we have seen, there are trading fees involved. That's called frictions. So even with those assumptions, this theory is not perfect. But since we don't have really a better model, so that we still use this model. And various attempts have been made to adjust the model. For example, the Pharma and French 3 factors model, they try to consider, in addition to the market risk, they consider the size of the company, the value versus growth of the company. So they call it a 3 factors model. You could create a 5 factors model, including the market, the size, the value factor, the momentum factor, liquidity factor. But the more factors you include, the more complex the model, and people generally do not like that complexity. So CAPM, the one-factor model, is still widely used. So it's a practical, easy to implement, and robust. And the last few things talk about how to forecast beta. So what's your time horizon? And if you look at Yahoo Finance, it typically use 5 years monthly data. Use SP 500 as market index, market proxy. And beta may change over time. And if we look at the beta for Cisco, going up, down, up, so it's dynamic. So is beta a constant? No, beta will vary over time. It's called a time varying volatility. That is another Nobel Prize winning theory. And I would highly encourage you to estimate the betas using these different techniques based on value line, Google, Bloomberg, Yahoo. They estimate the beta using different return intervals, horizon, indices, and do any adjustment if necessary. Okay, so that you try to replicate it, see if you can get the same results. Then you have a deeper understanding of beta. Replication. Okay, replication. Okay, and there are outliers. How you deal with those, and that's controversial. And here's a beta estimation with and without outliers. Okay, so that could change the beta dramatically. You see. Okay, so the blue line has a higher beta, whereas this red curve has a lower beta. So critical thinking skills are important here. Use your best judgment. The last slide, the environment, changes in environment of the firm may cause the future to differ from the past, especially with this COVID-19. This virus changed a lot of things. And it will be interesting to look at the impact of this COVID-19 on the beta or riskiness of the companies. And if you are interested, reach out to me and I'll be happy to work with you on this topic to see if we can get a research project going. And thank you so much for your attention. And that's all for this chapter. And if you do have questions, please feel free to reach to me.
Sounds good, Professor.